Good morning and welcome to the Killik and Co Market Update. The latest UK government borrowing figures have just been published, and for the month of June there was a new record in the amount of interest that the government has had to pay on its debt in any given month. The reason the latest figures were so high is that about 25% of outstanding UK government debt is inflation linked, and what's more, it's linked to the RPI rate of inflation rather than the CPI rate, and the RPI rate tends to be higher. For the month of June, RPI was 11.8%, so that's the reason the government has had to pay so much interest on its outstanding debt. This chart here shows the amount of monthly interest the government has paid going back to July 2020. The pink parts of each bar show the amount of interest that's related to inflation linking, and you can see that was very high for the month of June, and that's the main reason why the government had to pay almost £20 billion in interest in June of this year. And this will be a key issue for the Conservative leadership contest that's happening at the moment. Rishi Sunak is keen to use money to pay down some of this debt, whereas Liz Truss is more keen to reduce taxes, which would make it more difficult to pay off government debt in the short term. This week, the European Central Bank announced that it will be raising interest rates by 0.5%. For many years now, the bank has had a negative deposit rate, but this 0.5% rise will take it back to neutral territory. And this prospect of higher borrowing costs did cause a few wobbles in European markets on the day that this news was announced. When interest rates rise, we tend to find that bond prices fall, and we've certainly seen that happening over the last few months across Europe, the UK, and the US. Here's the Bloomberg Sterling Corporate Bond Index over the last 15 years. It measures the prices of bonds that are due to mature within the next 3 to 5 years. And you can see the prices of bonds went up quite a lot following the financial crisis when interest rates were reduced, but bond prices have fallen now that interest rates are on the rise again. Here's a specific example of one bond, but let's remind ourselves first how bonds work. They're generally issued at a price of 100. They pay a fixed amount of interest each year, and then the holders should get 100 back when the bond matures, as long as the company that issued the bond is still trading. This chart shows a Marks & Spencer bond that was issued in 2020 and is due to mature in May 2026. The coupon is 3.75%, which means that anyone holding it will receive 3.75 pence per year. Between the issue date and the maturity date, the bond can change hands at different prices. When interest rates are low, that 3.75 pence per year might look attractive, and people might be willing to pay more than 100 pence for the bond, even though they'll make a loss on the price if they buy above 100 and hold it until maturity. When interest rates start rising, that 3.75 pence per year becomes less attractive, and people might start selling the bond, pushing the prices down. When we look at bond yields or annual returns on bonds, we measure something called the yield to maturity, and this accounts for the 3.75 pence per year in annual income, and it also accounts for any loss or gain that will be made on the price of the bond. For the bond on the screen, the price is shown by the pink line and the yield to maturity is shown by the green line. You can see that recently the price has dropped below 90 pence, meaning that the yield to maturity is now above 7%. People have been avoiding bonds for quite some years now because prices have been high and therefore returns have been low. But over the last few months, we've really seen that turn around. So please do give us a call if you'd like to talk about investing in bonds. And finally, I'm sure no one has failed to notice that it's been pretty hot in the UK this week. There's been a heat wave with the temperature in the UK exceeding 40 degrees Celsius for the first time in history. Here's a map showing the risk of fire across Europe on Tuesday, which was the hottest day this week. And you can see there are lots of red areas showing a very high risk of fire. And this has really made the prospect of climate change feel a lot more real. And it's really outlined the importance of investing more into low carbon energy sources. Moving on to have a look at next week, you can see it's very busy on the company calendar, but we're looking ahead to results from some of the biggest companies in the world, Alphabet, Microsoft and Amazon. That's it from us. Enjoy the weekend, and we'll see you next Friday.